Breaking news. The Federal Reserve just flipped. That's right. After months of fighting inflation with high interest rates, Jerome Powell just signaled a massive pivot. And to many investors, it feels like money printing is back. So what does that mean for the stock market? Is this the start of another bull run, or just a sugar high that could end badly? Stick with me. I'm going to break it all down. What happened, why it matters, and how you should think about it as an investor. What just happened? In his Jackson Hole speech, Fed Chair Jerome Powell struck a tone that surprised a lot of people. Instead of doubling down on inflation, he shifted towards supporting the labor market and overall economic growth. In plain English, the Fed looks ready to cut rates. Markets immediately priced in a 25 basis point cut for September. And some analysts are saying we could see a whole cycle of cuts stretching into 2026. That's a complete reversal from just a few months ago, when Powell and other Fed officials were warning about keeping rates higher for longer. The reaction was explosive. The Dow popped more than 800 points, hitting a record high. The S&P 500 rose about 1.5%. The Nasdaq surged nearly 2%. Bond yields fell, the dollar weakened, and rate-sensitive sectors like tech, housing, and consumer stocks ripped higher. In one afternoon, the tone of the entire market shifted. Why people call this money printing? Now, technically, the Fed isn't literally printing cash. There's no new round of quantitative easing, no stimulus checks. But when the Fed signals lower rates, more liquidity, and easier borrowing, markets treat it almost the same way. Think about it. Cheaper mortgages equals more home buying. Lower credit card and auto loan rates equals more consumer spending. Businesses borrow more cheaply, which boosts profits. And investors, hungry for returns, move money from cash into riskier assets like stocks. It's the same playbook we saw in 2009 after the financial crisis, and again in 2020 after the COVID crash. Both times, Fed easing fueled huge rallies. That's why people say money printing is back, because liquidity is like oxygen for the stock market. What it means for stocks. So let's break this down. In the short term, this is rocket fuel for equities. The old saying, "Don't fight the Fed," exists for a reason. When the Fed is easing, stocks usually climb. And that's exactly what we saw after Powell's comments. Tech stocks benefit the most. Their value is tied to future earnings, and when interest rates drop, those future profits look a lot more attractive today. That's why the Nasdaq jumped the hardest. Home builders, real estate, and consumer discretionary names also shine in these environments. Lower mortgage rates drive home sales. Cheaper borrowing means more shopping, more car sales, and more travel. But, and this is a big but, not everyone's buying the hype. Some analysts are calling this a late summer rally, warning it might not last. If upcoming jobs or inflation data run hotter than expected, the Fed could backtrack, and all this optimism could vanish fast. Valuations are another risk. The S&P 500 was already stretched before this rally. Add in a fresh wave of liquidity, and we could be looking at bubble territory. And remember, bubbles don't usually deflate gently. They pop. Lessons from history. We've seen this movie before. In 1998, the Fed cut rates to stabilize markets after the long-term capital management collapse. Stocks surged. In 2009, after the global financial crisis, quantitative easing ignited a powerful bull market. In 2020, emergency stimulus during COVID sent markets to record highs in record time. Each time, the short-term impact was bullish. Liquidity pumped up asset prices, but each time, the longer-term consequences were bigger. More debt, and eventually another tightening cycle. So yes, today's pivot is exciting, but it's also a reminder. Every Fed rescue comes with a bill due later. Beyond stocks, the bigger picture for long-term investors, this is a double-edged sword. The rally could keep running, but volatility is going to be higher. Staying diversified matters more than ever. For short-term traders, this is opportunity central. Fed pivots create sharp moves across the board: stocks, bonds, and strategies. Currencies, commodities. That's both exciting and dangerous. If you're nimble, you can catch big swings. If you're careless, you can get crushed. For bonds, falling yields mean higher prices. Treasuries already rallied after Powell's speech. For currencies, the dollar weakening could help US exporters and multinational companies. And for commodities, things like gold and oil often get a boost when the dollar slides and liquidity rises. What to watch next? All eyes now turn to the Fed's September meeting. A 25 basis point cut looks likely, but the bigger question is, how many more cuts follow? That depends entirely on the data. If inflation keeps cooling and the labor market shows softness, the Fed has room to ease. If inflation flares back up, the Fed could find itself in a very awkward position, wanting to cut but unable to without reigniting price pressures. So don't just watch the headlines. Keep an eye on the jobs report, CPI, and PCE inflation numbers. They'll tell us whether this pivot has legs or whether it's just a short-lived burst of optimism. So where does that leave us? In one sentence, the Fed has flipped. Money printing, or at least the feeling of it, is back. And the stock market is partying like it's 2020 all over again. But here's the truth. This could be the start of a powerful new bull leg, or just a temporary sugar rush before reality sets back in. As investors, the best thing we can do is stay informed, stay disciplined, and remember that the Fed may set the stage, but the market always writes the final script. Thanks for sticking with me. If you found this breakdown helpful, make sure to share it with someone who's been asking what's going on in the markets, because the story isn't over, it's just beginning.